Thanks a lot, Shiva, for the kind introduction, and thank you, Peter, for the invitation to present here today. It's great to be here. I've given this presentation the title, What Determines the Impact of Mandatory IFRS? And that's clearly a very ambitious question. So I'm going to start by admitting that I'm not going to be able to answer it in the next 30 minutes. But what I will do is I'll walk you through the key findings of two papers that looks at different aspects of this question. And both those papers I've co-authored with Edward Lee and Martin Walker. They're both based at Manchester Business School, where I'm also a PhD student, at least for a week more. Martin is also here today. So the background to these papers is that many countries around the world have recently forced listed firms to adopt IFRS. And the general motivation for doing this has been to improve the information that's available to financial markets, and through that hopefully lower the cost of capital. So in the case of the EU, this has been explicitly stated. In other cases, perhaps a little bit less clear, but it's generally the motivation that's put forward for this policy. If we look at prior literature, and by prior literature I mean literature written prior to 2005 when we wrote the first paper, it focused largely on whether IFRS is a good thing or a bad thing. So a typical research design would be to look at voluntary adopters and then calculate the implied cost of equity capital before and after adoption, and then see whether it increased or decreased. If it increased, it was a bad thing. If it decreased, it was a good thing. An alternative methodology has been to look at the announcements returns, so the returns on announcements of future mandatory compliance. And if there is a positive market reaction on these days, it is interpreted as IFRS being a good thing, and if there's a negative one, it's interpreted as IFRS being a bad thing. So Edward's paper is a good example of this. We take a somewhat different approach in our work. We don't assume that the implications are uniformly distributed among firms. Rather, we hypothesize that it varies. And in particular, we hypothesize that it varies with the willingness that a firm has to adopt these new standards. So I'm going to structure the presentation in the following way. The two papers are fairly different if you read them, but in this presentation I'm going to focus on the things that are common between them. And the most obvious thing is that we assume that these economic consequences are not uniformly distributed among firms. So the first paper, as I said before, we wrote that in 2005. So that's prior to us having any post-adoption data. So what we're looking at there is the anticipated effect, and in particular whether there's any differences in these anticipated effects. And then the second paper, we wrote the first draft, I think it's 6 months ago, and we're still working on it. So for this paper we have the post-adoption data, and we have the annual reports of those firms, so we're able to look at what happens to accruals, what is happening to the accounting, and in particular, are there differences? Is there differences among firms, and what happens to the properties of these numbers? And then I'm going to conclude and talk a little bit about implications. So it's often claimed that IFRS is a principle-based set of accounting standards, and to me personally, it's hard to imagine any set of accounting standards that doesn't include some kind of principles. But it's certainly true that there's a lot of choices. So these choices relate to how assets are valued, and there's also some discretion on when to recognize an asset or a liability. Clearly this flexibility is motivated by the fact that these standards are designed to suit many different kinds of firms. So firms operating in different countries and in different industries. However, this flexibility also means that we can have two companies with essentially the same economics but very different balance sheets. It also means that it's very hard to imagine that IFRS in itself can force much new information out, at least when it comes to accruals, perhaps more so when it comes to disclosures. So furthermore, we also know from settings around the world where firms have been given the choice to voluntarily adopt IFRS instead of local GAAP, that not all firms adopt IFRS. Some do, but some don't. So, and we know that this choice varies systematically among firms, depending on the size of the firm, the financial structure of the firm, and the foreign exposure. So this suggests that the perceived benefits that firms have of IFRS varies among firms. Not all firms perceive it as equally beneficial. So what essentially we do in this research is that we exploit these two facts. The fact that there's a lot of flexibility in IFRS, and the fact that that the perceived benefits varies among firms. And then we suggest that the firm's perception of IFRS is likely to affect the way they implement IFRS, and possibly also the economic consequences. So the first paper has a very long title. It's called Cross-Sectional Variation in the Economic Consequences of International Accounting Harmonization, the case of mandatory IFRS adoption in the UK. So here we focus on the UK and the economic consequences of IFRS adoption in the UK. And as I said before, we're using data from before actual adoption. So what we do here is we exploit the fact that an efficient market should incorporate the anticipated benefits into price as soon as the market knows that this policy is going to be implemented. We don't have to wait until it's actually implemented. Furthermore, we exploit that there's another big country in Europe, Germany, that has taken a very different approach to IFRS adoption than the UK. So in Germany, firms have had the choice to adopt IFRS rather than local GAAP since '98, and a lot of firms have chosen to do that. Contrary to this, in the UK, firms could only adopt IFRS prior to 2005 by dual reporting, so by producing two sets of accounts, one according to IFRS and one according to UK GAAP. That's costly, and consequently we see almost no voluntary adoption of IFRS. So what we do then is we simply model the choice in Germany to voluntarily adopt IFRS, and we model it as a function of size, the financial structure, and the foreign exposure of these firms. And then we take this estimated model to the UK. We put in the data for the English firms into this model based on the same databases that we got the data from the German firms, and then we back out of this a probability that a firm would have adopted IFRS if it had been given the choice. In other words, we arrive at sort of a proxy for the willingness of a firm to adopt IFRS, and obviously that takes a value between 0 and 1. So now we need some economic consequences to see whether there's a relationship. So here we rely on market reactions to public announcements, and we also rely on sort of longer term changes in the implied cost of equity capital. For both of these methodologies, we need to identify a period where the probability that IFRS would become mandatory changed. It doesn't have to change from 0 to 1, but it needs to change enough that we can pick it up statistically. So what we do is we read the Financial Times and other media, and we find that prior to '99 there's virtually no discussion of mandatory IFRS from 2005 in Europe. After 2001, all the commentators expect that it will become mandatory, and it will become mandatory from 2005. So in that period of uncertainty, we then identify 7 events that we think change the probability, or that change the probability where we don't think the market had fully anticipated this before the announcement. So clearly, if any of you have read Edward's paper, you will realize that this is a very different period than what they rely on. So they rely on a much later period. And that doesn't necessarily mean that any of us are wrong. I mean, there could be different periods of uncertainty that could be exploited. But it does illustrate well that these events are open to discussion. And that's not uncommon when you have sort of a policy being implemented over so many years as this has been. So we don't want to completely rely on these announcements. So we also look at what happens to the implied cost of equity capital from before the period of uncertainty to after, and see whether that is correlated with our proxy for the willingness to adopt. So these are the results on the 7 announcements. We're using a portfolio approach. It's described in Sevcik and Thompson, 86. I'm not going to go into details of the methodology, but basically, if our hypothesis is supported, we want to find positive numbers in this table, and we find mainly positive numbers, and we find 3 of them are significant. And in the, as you can see in the last down here, the net effect is positive and highly significant. So that supports our hypothesis. Then this is the test for the implied cost of equity capital, and this is the important one. We find that indeed over this period there's a negative correlation between the willingness to adopt as we proxy it and these changes in implied cost of equity capital. However, we find this not to be the case for companies cross-listed in the US, so for example with an ADR listing. And that's a result that we found in later papers as well. That the effect of IFRS seems to be lower for firms that are cross-listed in the US, and it also fits pretty well with the results that Edward and his cohorts found, so it seems to be fairly robust. The second paper looks at, or is called Incentives or Standards. What determine accounting quality changes around IFRS adoption? So this is the paper that we're still working on, and where we have post-adoption data, and where we are particularly interested in seeing what happens to the properties of accruals. Does anything change? So prior literature that have looked at this have focused on voluntary IFRS adoption. for the obvious reason that there hasn't been any mandatory adoption until recently. And these papers, and that's a lot, maybe 100 or 200, but that's a lot, they generally find that that the properties do change around voluntary adoption, and that they change in a direction that could be interpreted as a higher accounting quality. However, the problem here is that voluntary IFRS adoption doesn't sort of happen in an average year. It tends to happen in a year where a lot of changes are happening at the same time. So we know that just after a firm voluntarily adopts IFRS, it's much more likely to issue external financing, much more likely to invest more heavily, and to attract more analysts following. So the question is whether we can attribute these changes to the standards per se, or whether it's sort of a correlated outcome of all these other changes that are happening. So for this paper, we use only German data. In Germany, local GAAP is generally perceived to be lower quality than IFRS. So when I talk about quality here, what I mean is in terms of informing an outside investor. So all the firms in our sample change from local German GAAP to IFRS. So if this perception of accounting of the quality of the standards is correct, and if then we should observe that these accounting quality improve for all firms in our sample. So that's quite a nice feature about Germany, that we have this, that the standards are perceived to be lower quality. But what is really interesting in Germany is that firms have had the opportunity to voluntarily adopt since '98, as I said before. So economic intuition suggests that a firm that voluntarily adopts IFRS does so because it perceives net benefits. Contrary to this, firms that did not adopt, that resisted adoption until 2005, did so because it didn't perceive any benefits. These firms could have adopted IFRS in any of these 7 years prior to mandatory adoption. And it's important to remember here that there was a general perception that IFRS was of higher quality, and you also had some pressure from the auditors and so on that were arguing strongly for voluntary adoption. These firms didn't adopt voluntarily. And that's an interesting group to look at. And it's somewhat different from studying the consequence of mandatory adoption in most other settings, like for example the UK, where there's no voluntary adoption. In the UK, the economic consequences of mandatory IFRS will be driven both by firms that perceive net benefits and firms that don't perceive net benefits. And we know that many firms perceive net benefits of IFRS. We know that from survey evidence prior to actual adoption, and our paper also provides some support, the first paper I talked about, that there are these differences in perceived benefits. So what we do is we hand collect data on the accounting standards applied and what year firms change to IFRS, and we find that 60% of firms voluntarily adopted IFRS and 40% resisted IFRS until 2005. So then the idea is to look at what happens to the properties of these numbers for these two groups, and are there any differences. So this is the first result. This is properties of earnings that are generally described as earnings management, and the first one here is the variance of changes in net income, and this is for voluntary adopters. So it's for firms that perceive net benefits of IFRS, and what we see just around adoption is that the variance does increase. So that's consistent with less smoothing of earnings. However, that could be driven by changes in the underlying cash flow. So what we do in the next line is we control for that, and we find that's not the case. In fact, the effect comes a little bit stronger when we control for that. Then we look at the correlation between accruals and cash flows, and we find that the negative correlation decrease a little bit. That's consistent with less earnings management as well. And then finally we find a negative coefficient on small profits. So that would have been consistent with less management towards a target had it been significant. It's not here. So if we look at the table, this is generally consistent with prior literature. It's a little bit stronger than most of their results, and that we think is mainly driven by the fact that we have hand collected the data on the accounting standards applied. So prior literature rely mainly on databases which are not very accurate in this field. So then we do the same for some timely loss recognition variables, and we find essentially the same result: more timely loss recognition after voluntary adoption. So this is for resistor firms, so firms that resisted adoption until 2005, firms that don't perceive any net benefits of adoption. And here we find that the variance actually decreases of net income. So that is consistent with more smoothing, but as you can see in the second line, we find that this effect is mainly driven by the underlying cash flows. We find very little change in the correlation between accruals and cash flows, and finally we find a positive and significant coefficient on small profits, which is consistent with more managements towards a target. We find the same for timely loss recognition, that in general very little is happening. So this is very different results from what we found for the voluntary adopters, where we found a strong effect, which we didn't do here. So let me conclude a little bit on these two papers. We conclude that the economic consequences vary among firms, and that the variation is, at least to some extent, explained by firms' willingness to adopt IFRS. So some researchers call this incentives, a firm's incentive to adopt. But it's important to realize here that our definition of incentives is much more narrow than what is used in prior literature. So prior literature include things like, for example, enforcement. The only thing we mean by incentives here is that a firm is actually think this is a good idea, this policy. It's also consistent with IFRS per se, not changing the properties of accruals or necessarily the outcome of these market-based numbers. So what are the implications of this? What we would say is that it's hard to talk about IFRS as being either a good thing or a bad thing. It's basically what firms make it. So there's no doubt that a firm can use IFRS adoption to improve accounting quality. It can use it to change its accounting policies. It can use it to get rid of whatever crap it might have in its balance sheet and start over on a fresh. But we have found no evidence that IFRS indeed force firms to do that. So that leads me to the last point in the presentation, that is our results suggest that we cannot improve accounting quality for all firms in the economy simply by forcing them to comply with what is perceived to be higher quality accounting standards, because firms that don't perceive net benefits of doing this are unlikely to respond by higher accounting quality. Thank you.
Thank you.
Hans, I wonder, you use German firms for a lot of this, and I always wonder when I look at those studies, there have been other studies that have indicated that the German firms in general don't apply the rules very well. The new market blew up. And so we've had in some of the prior presentations people talk about things like implementation being different, etc. How much can you separate out here? Instead of reaching these conclusions, maybe if we had a little more oversight going along with the change in the standards, that we would in fact get the benefits?
That's, we cannot, I mean, so it's very likely that you could reach this by enforcement, I mean that you could, but remember our results show, so basically this evidence that you're referring to, I think, is particular. There were some reports, especially in around 2000, that show that firms didn't comply very well with these IFRS standards, but remember that's the ones that show accounting quality improvements in our sample, so that should sort of work against us. But it's true that for the resistor firms, it could easily be because there's not a lot of enforcement going on there. That could be an issue. We haven't found any evidence that they're not complying. So to all these firms, I've looked through to the audit opinion, and they're all clean audit opinions. So there's no obvious sort of non-compliance, but it's true that it could easily be by enforcement you will reach a different result. I agree with that. But that's exactly the point, that it's not the incentives, it's not the standards in themselves, sort of, you need something else to get there.
And yet another point, in terms of these incentives are not, in terms of the enforcement is not endogenous to the incentives. It's only when there are the incentives that the enforcement actually follows upon it. So, in fact, it's actually supporting them. Even if enforcement improved, that would have improved only when the incentives actually improve. And so just merely having these accounting standards is not going to change things. Right.
I don't know if that interpretation is correct, but one thing that I'm thinking here is that you seem to find that there is no change in the accounting, like in the accounting quality for firms that resist, and I buy this argument and I believe in this result. That doesn't mean that there is no benefit, because this firm, even if the accounting change doesn't change anything, you could attract more investors, you could increase liquidity and those things that you can't look in here, right? So you can have a benefit even if the account is exactly the same before and after there's options. Is that
Yes.
right?
Yes, that's correct. So we're not trying to say that there's no benefit, so that it could be easier to compare as well across countries, of course, across companies. But the point is just that the standards in themselves are not going to make the numbers necessarily look different than they did before.
Yeah.
So, but there could be many, I think especially in the disclosure, I think that's a good point, you know, because there are more disclosures. That I generally noticed that because I went through all these annual reports. I saw that they did, it does seem to increase the disclosure. So there's a point. But at least these properties of numbers, they're not going to change. That's not going to be easier probably to compare firms after IFRS necessarily.
Luigi?
So looking at your event periods in the first study for the UK firms, then there was virtually no overlap to Eddie's event studies.
There's
right?
absolutely no overlap at all.
Yeah. So going back to Peter's earlier question, do we have to simply add your abnormal returns to Eddie's returns?
Our returns are actually not, you cannot take, this is a portfolio that's weighted on the willingness to adopt. So all it shows is a cross-sectional difference. We don't show if there's a positive or negative reaction actually. So you can't see that. But this whole exercise with adding up returns would require that you had 100% change in probability. Otherwise it's a bit hard to infer anything on the cost of capital, of course. And none of these studies has that, that's for sure. There's so many events, yeah.
If I could just comment on that too, back to Peter's question, right? Obviously, this whole IFRS adoption was a very extended and protracted process, right? So to the extent that you're conducting any type of study that's restricted within a certain sample period, you're only going to capture some partial effect of what the overall expected response is to adoption and what the implications are. But I think your point is generally directionally going to be correct, right? If you want to get the full response, you got to get the entire series of events that changed over the entire adoption period.
Yeah, but not even, you need every one of them to get 100%, I mean.
Right.
Yeah, which is going to be impossible, of course.
In your second paper, you've been focusing much on the properties of earnings kind of measures. And when we switch over to IFRS, we have basically two effects. One on the measurement side, which you capture, and another one on the notes or increased notes disclosure side. Now, I'm not sure those properties of earnings measures capture what they intend to, what they should, in the transition period you look at, because you're basically using 2005 and 2006 data maximum, so you have a clear IFRS 1 adoption effect, which heavily influences those property measures. So given that you intend to capture concepts like income smoothing, let's say, I think it takes more time to precisely measure those effects than just a year or two influenced by the transition options.
Yeah, I think that's a good point. What we try to do there is we try to limit it to 2 years around the voluntary adopters. And there we see certainly not everything is statistically significant. Depends on how we measure it, whether it's statistically significant or not. But we find that the effect happens immediately on the voluntary. I'm not sure that's necessarily accounting quality, but there seems to be something happening around these voluntary adopters where the properties are changing of the numbers, and it happens within the first couple of years. But I agree, maybe we're going to find some of these effects later on. I mean, that could be. But of course, when you adopt IFRS, you write your accounting policy section, and you're not going to change that the year after. That sticks with you for a long time, unless you have a very good argument for changing it. So, yeah.
I guess if there are no other questions, we can take a slightly earlier lunch.